Hello everyone, and welcome to the local park where the birds are happy, the children are swinging on the swings, kicking the soccer ball around, the football around, I'm sorry. Well done Italy, by the way, congratulations to Italy. Today in Australia, we've announced a third week of lockdown in New South Wales and the stock market has gone through the roof again. Well, when I say through the roof, it actually hasn't, because there is a ceiling on the market at the moment. And we've had nearly 2 weeks now of very broad range trading. And it makes you wonder if some big institutions or one or two big hedge funds out of the US or something don't have some kind of options play on the little AUS 200 market and are spending enormous amounts of money to keep it in a certain range so as to get a huge payout at some point. Things like this used to happen to the Australian dollar in the 1990s. And that was a very large market too at the time. So who knows what exactly is going on, but it's very odd price behavior. And it seems to be that a group of traders, range traders, just know, because from experience, not necessarily manipulating the market or anything, they just know to buy when the market is down towards the bottom of that range and sell when it's near the top, because they either know or they sense that there's someone bigger, a little bit further out, prepared to buy and sell outside of that range that we've seen. So for the moment, the Australian stock market's had a huge move to the upside on very negative news in the midst of very volatile US markets, in the midst of a falling oil price. One market that does look interesting is gold. Perhaps it's one of the, safe is a strange word to use in these markets, but it might be an interesting play. That doesn't mean it won't have some big swings and some volatility, and you might buy gold and immediately be underwater, because that's the nature of markets at the moment, no matter what you're involved in. That could be an interesting trade. And the other interesting trade, I think, would be to sell the Australian dollar. Both euro and sterling look very heavy here, but then again, US stocks looked very heavy on similar hourly kind of price action yesterday before they had a big recovery. So markets are extremely difficult at the moment, and it's a combination of, I think, sort of a kind of meme stock market buying and selling periods mixed with big funds prepared to buy dips and sell rallies. And so that's just creating these sort of, there's not a lot of liquidity within the range, and so the markets move quickly through those range with a very one-sided kind of take on things. So the market's able to move quickly through those ranges. It's sort of like there's thin air there, and the market tends to be people running from one side of the boat to the other, back and forth. Now, in the big picture sense, on the economic fundamentals, there's a few things I'd like to mention to you that I'm highly confident of. They're not all good things, but let's start with, I think most economies in the world are going to be running sort of 92 to 98% of their 2019 levels over the next 1 to 2 years, and then after that be moving into greater total absolute GDP valuations for their annual growth. So it's still a stalled global economy. I'm highly confident we still have significant supply chain disruption. I'm highly confident that is dissipating, but is still there. I'm extremely confident we're going to have rampant inflation, way beyond the market sentiment expectations at the moment. Inflation that really forces central banks to consider raising interest rates, even though they'll be coming off the boil from those stimulus post-pandemic sort of boom economic data periods. So their economies will be looking so-so, normal-ish, but not anything, not a boom to justify recent equity market strength, that's for sure, the last 12 months of it. But that's a personal view. But the thing I'm very confident of is that every company and business in the world is seizing the opportunity to raise prices, maintain and even greatly enhance their profit margins at this point in time. And that process is going to be ongoing for many months. So we're going to have higher prices, high inflation, and I think these higher prices are going to be set in stone long term. You're not going to see prices moving back lower. You're not going to see that price competition we used to have in that open globalization period of the previous 15 to 20 years. We're just not going to have that again for another 5 years or so. During this period, services, products, prices will be higher, permanently higher. This will result in labour groups justifiably asking for pay rises. And again, that will be another inflationary pressure. So with commodity prices as high as they are, there's certainly downside for oil, but probably the downside for oil, even if it went to my 65 or 61.5 target, wouldn't be enough to reduce inflation that significantly. So getting back to my key point, central banks like the Federal Reserve, the Reserve Bank of Australia, are going to have to deal with the complexity of rampant, sustained inflation way beyond their current expectations, combined with so-so, technical term, economic data runs. What will they do? They'll at least discuss completely eliminating bond buying programs, and they will discuss having to raise interest rates sooner than they had previously thought. Now, once they start saying those sorts of things, perhaps that will be a further catalyst for downside action in the equity market. Overall, for the moment though, probably volatility is a really big indicator of major turning points in markets in a long-term sense. We're absolutely seeing that at the moment on a day-by-day basis. We're seeing new highs in the NASDAQ, but not in the S&P and not in the Dow. Though through Asia, they've started to look a little bit more encouraging going towards Europe. I think there's an expectation that Europe will want to buy the dip in the Asian market, so we'll see what happens. London Open and moving forward through the European day. Into the US, it's going to be a very interesting session after that huge volatility. I tend to think the market will try the upside, particularly with the tech stocks once more. In 24 hours we'll be a lot wiser. It's almost like your long-term outlook is decided or determined by the next 24 hours price action because the swings are so big. The other fundamental economic reality is that probably we are going to continue to see a firmer US dollar overall. So I would think long positions, which are quite significant still, in sterling, the euro, and particularly the Australian dollar. I've said yesterday, you'll get that twin pressure on the Australian dollar of a higher US dollar and that pressuring commodities lower. I did mention or show a copper chart in the written report. If that resistance on copper were to be broken, I would go with that upside run on copper, but at the moment it's unthreatened and is possibly going to contain for further downside in copper along with other commodities. But that could be a little bit of a litmus test. Just keep an eye on that copper resistance there, that sort of a sort of flat top triangle, which is very clear and easy to see on the daily charts. General views, rampant inflation, difficult position for central banks, economies that are coming off the boil from their stimulus boom, a US dollar that will be firm due to US corporations feeling their high vaccination rates in the US means they should bring more money back to the US because the world still remains a little bit COVID uncertain, and that will pressure commodities and currencies. That's basically how I see the world at the moment. Determining the next 3 hours or 12 hours or 24 hours of price action is a highly difficult game at the moment, so you have to manage extremely actively. Or you can take a strategic view and just see how the price action, as I said earlier today, if we were to break those lows seen in the New York trading session yesterday, if we were to break those lows and close below there, I think it's almost all over for the bull market in stocks. So that's a pretty big thing. And that's well worth keeping an eye on. A lot of people will be looking for those levels to hold and for new highs to be made. The real tussle now is here, I think, between overextended bulls and bears who are very few on the ground. But their power to sell could increase if the bulls become exhausted. And just remember, I've said it before, when everyone who wants to buy has bought a market, all of those people, they don't realize it, but they have become nothing but a sea of sellers. Also bear in mind, I have said this at lower levels for US stocks, but it's just kept going, hasn't it? So that other scenario I painted of the world is just simply awash with money and fundamentals don't matter, could be a real possibility too. I think we should watch the range of the Dow Jones for the last 2 days and see what happens. Have a great day in London, have a great evening in Asia. Let's see what happens in New York. Clifford Bennett, Chief Economist, ACY Securities.